Of course, none of this is really reflected in fundamentals yet, the whole healthcare debate, but Oliver had a chart this week that he featured in Battle of the Charts, and he won, so he wanted to take a victory lap with the chart. So we're going to bring it out right now.
It's relevant. It's relevant as well as feeding my ego. All right, because you helped me build this, too, originally way back in the day when we were first looking at CapEx, because we talked about CapEx after Trump got elected and this big boost. Well, I just kind of combined a few points here, and the idea is that we got to think about what's going to happen. What are the implications if Donald Trump can't get done what Donald Trump wants to do? And part of that, I think, is reflected in the potential reversal of all this optimism and CapEx sort of speculation that we've seen in the market. And that's what you're seeing here in this chart. Top panel shows the business optimism in blue. White is CapEx forecast for the S&P 500. On the bottom panel shows the ratio of CapEx to buyback stocks. People have been buying companies that are going to do CapEx. What does this mean?
Yeah, and I mean, I think if you look at, today obviously the hot topic being the healthcare bill, but even looking a little bit more forward-looking, you could say, this CapEx move is going to be interesting because, one, you can look at some of the healthcare companies. Actually, in that CapEx index, a large part of that is healthcare companies. Some of the bigger ones, you'd expect like the industrial companies, some that are a little more capital intensive to be a larger weight in that, but it's actually kind of focused on consumer discretionary, infotech, and healthcare companies. So we can't discount how much of an effect healthcare will obviously have on the broader market, but in terms of looking at companies that are going to spend more, the second part of that is everything that happens with tax reform, right? Because when we talk about the bottom lines of these companies potentially getting better, right, towards, potentially the end of this year, a lot of that money potentially could go towards some of these capital intensive or CapEx initiatives that we haven't really seen so far as of recent.
So these are all potential scenarios. How are analysts folding this into their fundamental analysis of where earnings are headed? And for that, we have G#BTV7111. This kind of looks out for the 4 quarters. Walk us through this.
Yeah, so this is a really interesting chart. I have to give a shout out to my colleague Matt Turner, who helped me build this out. And so essentially what we're looking at here is the earnings per share revisions by quarter for 2017 for the S&P. So just kind of the blanket statement in the beginning is that each quarter is expected to have growth, right? But we're looking at the revision, so the change, so that expected growth change.
Got it.
And so we're seeing the bottom 3 lines, essentially, it goes actually in order. The white is Q1, the teal is Q2, and yellow being Q3. You're seeing some of these revisions come down so far for the first 3 quarters of this year, but where they're putting a lot of weight is on that 4th quarter earnings, which may be implication of when you think some of these whether it's tax policy or some of these other policies may get pushed through in Washington.
So this basically gives us an idea of when perhaps at least the street thinks that some of these policies are going to make a difference on the bottom line.
Absolutely, that's exactly what it's saying.
Very interesting. Okay, all right, let's check out some valuations, because I know we obviously watch this a lot, and at the end of the day, after all this political and legislative sort of hand-wringing, there is ultimately a big concern about valuations at this level. What are you looking at here? Yeah,
so there's no shortage of indicators you could say right now that would argue for stocks being a little bit overstretched. These two are really important though because they're a little bit less conventional, but I think they say a lot about some of the concerning flashing warnings that we're seeing. So this top panel here looks at the price to EBITDA ratio. And why I like looking at this is because it kind of levels the playing field for a lot of these companies regardless of their industry. By adding back in things like depreciation and interest, you kind of remove some of the effects of how capital intensive the company is or how much leverage that company is using. So when we look at this ratio, we see that it's its highest point since not only 2009, but 2000. Wow. So we're going back pre-financial crisis. And then if you expand the bottom chart, we're looking at something similar, but for the price to sales ratio, which is obviously has some implications itself.